Crystal Kaldjob. I'm a partner at Morrison and Foerster, or MoFo for short. And after the panel, I will take MoFo jokes if anyone wants to give me any. I co-lead our Fintech practice at MoFo, and I practice within our financial services group. And I'm happy to have our panelists here. I'll do a quick introduction of each of them. So first, I have Mona. Mona serves as the Director of Public Policy and Research at Chime. I'm sure you guys are all familiar with Chime. Not only have they sponsored, or one of the sponsors for the conference here, but Chime partners with 2 national banks to expand access to affordable basic banking services, including fee-free overdraft for Americans that make up to $100,000 and live paycheck to paycheck. Next on our panel is Ryan. He's the Director of Public Policy at DailyPay. DailyPay, among other things, works with employers to provide earned wage access and financial wellness tools for employees. Ellie is the Deputy General Counsel at Affirm. I'm sure we've all heard of Affirm, but Affirm, among other things, is a buy now, pay later provider. Last but not least, we have Chris Adams, who's here to represent one of banks. He's the chairman of Coastal Community Bank. Coastal has partnered with a number of fintechs in the banking as a service partnerships, including companies like Carta, Bluevine, Avon, One Finance, and X1, which was recently acquired by Robinhood. All of our, as Phil mentioned, all of our panelists their companies play in the banking as a service, buy now, pay later, and EWA spaces, and they have significant insights on what our panel is, kind of lessons learned in this industry. And we've come up with what we think are kind of 4 general topics to think about lessons learned in the banking as a service, buy now, pay later, and EWA markets. And with that, I'll just launch into our discussion. So I think we're all kind of well aware of, and maybe it's a theme that has come up in some of the prior panels, but what we're seeing is increased regulatory scrutiny of banking as a service, of buy now, pay later, and EWA. We heard a little bit about it in the previous panel, but I just want to maybe throw to our panelists. Maybe I'll start with Chris, since he's the representative from the bank. But we've seen increased regulatory scrutiny. We've seen reports out about the buy now, pay later market. We've seen enforcement actions against financial institutions related to their fintech partnerships, whether that's lending or banking as a service. And so maybe just, Chris, if you could start with, how are you, or thoughts about reacting to the increased regulatory scrutiny as a bank who partners with fintechs?
Yeah. No, it's a good question, and a lot going on right now, right? So I think that the concern that we have as a bank from Coastal Community Bank's perspective is the amount of uncertainty that exists out there. So there's uncertainty in terms of the regulatory environment, uncertainty in terms of the enforcement actions that are occurring, and then confusion that we're getting from partners in terms of what's happening in the space, right? Who's tied up and what are they going to be able to do? And I think it's a real issue, and I think the only way really to deal with it is through communication. So for us, we have 14 branches, and 7 years ago moved into the banking as a service space. And so now we've got a whole great group of partners that do a great job on the innovation side of things. And we've got a great relationship with our regulators, but we're still being attacked by bloggers trying to suggest that something may be coming down the pipe. And it's just one of these concerns that really, I think, slows down the space in terms of everybody thinking about who their partners are going to be and what the next steps are. And so I think it's one of the things you can really only solve it with communication, but it's a real problem out there right now.
And Ellie, I mean, as a fintech that partners with banks, it's probably top of mind and in your own right, dealing with regulators. So how have you guys, or are you thinking about kind of reacting to the increased regulatory scrutiny and any, lessons learned from your experience with the regulators?
Yeah, so at Affirm we have currently 4 bank partnerships, and we're, sort of as the business grows, we need to keep expanding those partnerships. I think from our perspective as, the lawyer that runs the regulatory side, Having a bank that cares a lot about your regulatory compliance and is, owning your product with you, and at every step of the way, innovating with you, asking the hard questions, ensuring that you're running a full compliance management system, all the monitoring and testing, handling complaints appropriately, feeding that all back into your risk prioritization. I think in the earlier days, probably at Affirm before I was there, but I've been at earlier stage companies, you don't want that kind of friction as you're trying to innovate. And it's difficult for an early stage company to move quickly when you have a bank partner that's questioning every single thing that you do. But when you reach the stage that we're at, and I think some of my colleagues are at with their companies, having that kind of attention from your bank partner and making sure that they're on top of the regulatory game just as much as you are is actually a value add and ends up saving everyone a lot of time and money on the back end. So I think we're constantly looking to partner with banks, the ones that we're already partnered with, many of which are in this audience somewhere, and others in the future that truly do value a robust compliance program, not just in the traditional like CFPB, CMS, consumer finance space, but also in the fin crime space, and ensuring that whenever there is a risk evolving inside your institution or with the bank, that there's open lines of communication, to Chris's comment, to make sure that everyone is aligned in handling those risks appropriately for whatever is happening behind the scenes with the regulator.
Yeah, interesting. I mean, it seems like, and I'll go to another one of the panelists, but it seems like, when we think about how a fintech starts, right, it's fast moving, and maybe compliance is an afterthought.
A nice to have.
A nice to have, but at least what I'm hearing is that, and particularly from you and Chris, especially in these times, it probably should be one of your primary considerations, giving the pressure on some of our financial institutions that are supervised and having bank partners and wanting a bank that's invested in. And Mona, I know at Chime, you guys have bank partners as well. So just what's your experience, thoughts on kind of how to react to this increased regulatory scrutiny that I think we're all believing is out there at least?
Yeah, I mean, kind of plus oneing what Ellie and Chris said. I mean, I think part of it, as well as like we also are believers in regulation. Like, so we sort of know what is happening out there is sort of like good for the broader ecosystem. Like, we are all better kind of when we know the banking system is safe and sound, and when banking system is safe and sound, we're able to serve our consumers better, and we're able to have stronger partnerships. So we, kind of generally believe like in everything, that is the kind of strong, regulation. And I think on our end, it's, I think kind of just to echo sort of like what's been said, it's making sure sort of like the compliance and the risk management is moving hand in hand with the product development and with the interactions with the bank. And that's sort of like how hopefully you land in the best spot at the end of the day. I do think that like, at fintechs, you like to move fast and you want to sort of see your product come to market as quickly as possible. But what the banks are doing in terms of asking the right questions, and that's being driven by the regulators, like that does kind of bring us all to the best place at the end of the day.
Yeah, right. I was going to say, so we have 3 bank partnerships and actually like a 4th, I think, that's being worked on. And we're the largest EWA company in the country, but we move extremely slow because of the vetting and the regulatory compliance work really done almost by like the more traditional banks that almost like, has forced our smaller industry, if you will, that just is coming out with like new products almost every day to really slow down and take stock of what is required right now, what could be required soon. And so a lot of times I used to joke that we're like the grandpa of the EWA industry, because we think about doing something and then like 22 months later we finally catch up with everybody else. But that's because we are sitting with armies of compliance attorneys from other large banks. So it's almost like a like a sign that like things are progressing in the right direction. To be honest, like once we kind of a startup that's innovative, and now I mean we're a maturing startup, we're 7 years old, but once we start to have to like really think about these issues and work on them in a thoughtful way, it shows that we're like mature, we're here to stay. And it's why it's led to things other than PNC Bank, which love PNC Bank, not the same as like Bank of America, right? So it's exciting. I mean, it's a lot more work for someone like me. I'm not gonna lie, but like it is, probably the most important issue that we all think about. Yeah.
So you all have mentioned having multiple bank partners, and Chris, you guys at the bank have multiple fintechs. Kind of on a similar note, with the increased regulatory scrutiny and consent orders, and just the perception that there's going to be more oversight, there's going to be more scrutiny of banks who are engaged in fintech partnerships, whether it's a banking as a service, whether it's a lending product, or other credit product. And you all have multiple bank partners. So let's discuss kind of diversification of bank partners and how or why it's important to you. And maybe I'll start. Mona, you'll start.
Sure. So at Chime, we partner with 2 nationally chartered banks. And, I do think diversification is no doubt, it's crucial. I think we're kind of driving towards when you're a fintech, how do you sort of preserve as much control over your own destiny when you're, offering products through a bank partner who could be subject to adverse, regulatory actions that you may not even know or see coming. And I think part of that is really thinking about we've kind of thought, greatly about who it is that we're partnered with and how do they view and how do they take stock, and are they serious about their own culture of compliance? I think that's a huge component in addition to the diversification about how you sort of really protect yourself. And to even go one step further, I think when you're thinking about really kind of making sure that you can continue to operate and do what you want to do in partnership with banks, it's also about sort of fintechs kind of taking it upon themselves to have a strong, culture of compliance, understanding what their bank's obligations are, investing in the governance, frameworks in order to help, not only risk manage themselves, but support the obligations that their bank partners have as well. So I think it's thinking about all of those different things as a way to just make sure that when you're operating as a bank fintech kind of duo, that you're just protecting yourself kind of in all the different ways to allow yourself to continue to manage against what could happen in the future.
Yeah, so I think our second largest funder was Silicon Valley Bank. So I think diversification really came in handy then, right, that weekend. It became very apparent. But I think that was why we were able to really survive seamlessly, or continue to grow and continue to maintain because of our other partnerships. So that's probably the thing that comes to mind first. I'm not gonna lie.
Yeah, for us, we have had bank partners that have been through some troubled waters with regulators, but I think one thing that is coming into focus for us is that this is sort of, as I've been saying, it's sort of like speeding tickets from the regulators. If you're out there, regulators, sorry, it's not meant to be derogatory, but all of the bank partners are gonna face scrutiny at some point. The FDIC has been pounding the pavement, I think, with their regulated banks. And when we think about it now, having had a partner that's been through that, one, it was coming for a long time. It's not something that happens overnight when you're talking about a regulatory action. And a lot of times the bank is building the infrastructure to meet the obligations under a consent order before it's even final. So in many ways, by the time you get to that finish line and something becomes public and everyone thinks, oh my goodness, this bank is in so much trouble, it's actually something that happened quite far in the past. And now the bank has a far more robust compliance program to manage those risks going forward. So I think there is something to be said about a bank who has been through troubled waters and reacted appropriately and sort of level set in terms of the risk tolerance with their regulatory compliance program, whether it's consumer compliance or fin crimes. It gives us some comfort, after our own diligence, of course, in that the bank is going to be a safer partner going forward because their eye is focused on those issues, and we'll make sure that you are too.
No, I completely get the need for diversification on the bank side. I mean, it's certainly, or on the fintech side, because I think, certainly you're dealing with all the risk and making sure that you go forward. On the bank side, there's also some complication too. I mean, from a deposit perspective, it's easier to classify as core, right? On the credit side of things, adverse selection and making sure that your agreements are robust in terms of what your credit relationship with your partners looks like. So it's an interesting transition for us right now because I think probably half of our partners have another bank partner in some form, typically for different products. And so as they even diversify with partners or think about product selection, we're trying to make sure that we're adapting along with that. Being a good partner, even though we understand that we're part of a multiple partner system, is certainly one of the things that we're growing into, and it's complex.
Yeah.
So.
I mean, adverse selection is the downside to it, right? Choice is, I think, the upside that we hear from the fintechs. So let's move to a topic that we were just discussing with EWA and short-term, kind of addressing short-term liquidity. We saw, I believe, PayActive's approval sandbox was withdrawn, however we want to characterize it, almost 18 months ago. We heard from Ram that there are several states that are enacting laws or guidance around earned wage access. We know the CFPB has said that it's going to update some guidance soon. How do we think about moving that market forward to address the short-term liquidity and some of the benefits that our previous speaker, Ram, had mentioned around the benefits of earned wage access? I'll start with you, Ryan, on this one.
Yeah, I think that the conversations and the actions in the different states have all been very encouraging. I think that the first two licensing laws in Nevada and Missouri were like a labor of love. They took Nevada, it took a little over 3 years, and they have a Democratic supermajority in both of their houses. And in Missouri, it only took about a year to get a licensing law passed. And I think in California and Maryland and Connecticut, you see proposals that say that we're credit, even though we're not a credit product, and then really a regulator kind of taking a step back and figuring out a way to work with industry so that EWA can continue to be offered in their states. So it's very encouraging, I think, because every time there's a conversation that's a little bit like less than fact-based about the attacks on EWA, like once any state gets close to making a finalized decision, it's immediately pulled back. And we're a very collaborative industry, and we not just collaborate amongst our other companies, but we collaborate a lot with regulators, with consumer protection advocates. There's a lot of shared mission, to be honest. And once everyone's able to sit down and talk and have a thoughtful conversation, things actually move forward in a productive way. So it's very encouraging. It takes time. A federal solution is always the best one. So it's great to see Ram going to the Hill, to be honest. So thank you. I'm glad. Add a couple extra meetings for me if you could. But I think in general, though, EWA is new, not just for regulators, but for elected officials. And so unless you have a state that's already considered a bill previously and had not moved it forward, it's usually the first conversation that anyone's having with these policymakers. And so it's been encouraging for that reason. So it's actually very exciting to think about what's going to happen come January, because there's a lot of great movement pretty much everywhere, which is nice.
Yeah, and I think this is a good segue maybe into kind of a topic around research and education of the regulators. And so maybe I'll start with Ellie, if you can give some thoughts on, because I don't want to bypass EWA quickly, but I do think it's a good thought about how do we educate our regulators, how do we do the research that needs to be done, right? You said EWA is a new product. I think we're all familiar with credit cards and other loan products. How are you guys approaching or thoughts about research and educating regulators about your product? And Ellie, I'll start with you.
Sure. Affirm's approach to sort of having an open door policy with regulators, state and federal, predates me by many years, but I'm happy to be part of that now. I, in previous life, spent 5.5 years helping to build the CFPB, and spent those years with people like Rohit Chopra and others that are now back running the place. And so I have a good understanding of how they view the world, and many of them have not worked in the private sector. So they're not able to see behind the curtains of what we're doing. A recent conversation I had, casually with a regulator was really mind-blowing to me. This person said, yeah, I heard at a conference that the buy now, pay later companies are going to start doing installment lending. Are you guys going to do that? And I had this point of sale installment lending is not new, and in fact was the first thing that Affirm did. And buy now, pay later, as they think about it, which is pay in 4, the 0% interest product, is actually less than half of all of our business, and actually maybe even a quarter at this point, just given where interest rates are. So they really don't know what we're doing. They don't understand our products, and finding ways to informally and formally educate them, whether it's through interactions that any of us may have with the research and markets teams at the CFPB, helping them to better understand how our portfolios are set up, how bank partnerships work. Even that I find to be very confusing for the CFPB. They've not spent much time in that space. Of course, the FDIC, the Fed, and the OCC, they're regulating the banks that are in these partnerships with the CFPB. They don't understand it. It's a very, I guess, nuanced play when you're trying to educate a regulator without them feeling educated, because you certainly don't want to offend them. So we've shared research historically. We're always working on our own research that we have a goal of sharing publicly when it becomes available. I think those sorts of initiatives, partnerships with nonprofits, if we can get them to talk to us, CRL, if you're out there, please talk to us. NCLC, we're willing to talk.
We're both not, I asked. No, I'm just kidding.
But really, reaching out and connecting with consumer advocates. I think there's this narrative that any tech is bad tech. I don't think, I know, because I live in DC and I run in these circles. Like, everyone thinks that fintech is bad, it must be bad, you're all trying to make $1 billion. That is not actually the case. There are real problems being solved through fintech that government can't possibly ever do on its own. And so finding ways to help shed a different light on our industry that isn't just a nefarious one is a thing that we're constantly doing. Our government relations team, I see some people here that are on our GR and policy team at Affirm, constantly up on the Hill, meeting with regulators, et cetera. I think one difficulty, though, and I'd like to pop it over to Chris, because I think one difficulty for companies like ours is having the voice with our bank's regulators. And obviously, we don't want to step over the bank and talk directly to regulators, but how might you recommend that fintechs better educate regulators through you as a bank partner?
We actually support that. So from the very beginning, when we got into BaaS, we put every fintech we worked with in front of our regulators and had them present and have a direct contact. Now, obviously, we're very involved, right, talking and part of the messaging and everything else too, but we fully support it. It's a big part of what we believe in terms of working with our regulators, making sure they know exactly what we're doing, but making sure our fintechs feel really comfortable with our relationship with our regulators too. So.
That's great.
And Chris, just maybe to follow up on that, how are you guys, other than putting your fintechs in front of your regulators, how are you educating your regulators about the products that you're offering through your partnerships with fintechs?
Yeah, communication, right? I mean, customer complaints would be a great example of, if you look at customer complaints under a community bank model, it doesn't work, right? Coastal Community Bank had 35,000 accounts when we got into banking as a service, and now we open tens of thousands per week, right? So if you think about customer complaints in the grand scheme of that, the data you have to look at it differently, right? So we have to be able to communicate, we have to have the data to support it. We've got to be able to talk about our credit products with our regulators using data. We've got to be able to talk about customer complaints using data. So we're investing a ton of money into data teams to help us do that. So.
And Ryan?
Well, I was going to say, I do think there's also, it's hard to have these conversations sometimes in a vacuum, because every state's law is a little bit different. And so it's in California, the regulator has a lot of flexibility. So, but if you go right next door to Nevada, there isn't. And so, for new products, sometimes the regulators who don't have the ability to either create a new registration regime, they'll try and jam you into a box you don't fit. And so then, legislation is almost like has to happen essentially, because then like really if the regulator doesn't feel like they have the flexibility, like the only alternative is for them to do nothing. And like for EWA, we exist in all 50 states. So that's usually never going to be, it's never going to be an option. So I think that's like the other part too. It's like, how do you go around and say, here's why we're good for people. Here's why you can do something other than, an enforcement action or other than like try to jam us into a lending box. And, here's, why you should do that. So I think that's been an interesting conversation depending on the region. And we will see how things progress, particularly I think with a state like California, which has the absolute most flexibility under the CCFPL.
Yeah. Oh, sorry. I was just going to say, just to add on to that, having sophisticated advocacy at the state level, which we're so lucky to have at Affirm, just top-notch GR policy team, partnering with AFC also, that is constantly boots on the ground in states where things are happening. You can't take your eye off the prize. Although we're all, constantly worried about what's going on at the federal level, the state level is so important as well. And so you have to kind of be minding all sides, which, often leaves us in places where we're like, if we were only a bank, we would.
yeah, seriously.
Go ahead, Mona.
Agree with you that, sometimes focus is on the federal legislation or regulation, whereas the interaction occurs on the state level and the varying degrees of, sophistication, and in no way to say that one state is more sophisticated, but more access to the fintech partnerships leads to an increased level of sophistication. And I know, for Chime, Mona, the thought, or the perception is that the product that you offer is a better product, right? With no fee, overdrafts and other features of the Chime account, that bank deposit account that's offered. So how have you guys thought about, both on the state level and on the federal level, educating about your product? It's not just a Chime branded account, right? It's something different than, just lending your name to a deposit account.
Yeah. I'm glad you said that the perception is that it's a better account, better product. We hope that is the perception. I think it really is kind of like what my colleagues have said. It's like kind of getting your narrative out there is so critical. I think we've all probably seen just a fair bit of skepticism, like kind of fast-growing, kind of technology-based companies, and sort of like the starting point is like, you must be doing something kind of nefarious. I think with Chime, like we've got like our free accounts. We were, first. We're extremely proud that we were first to sort of offer a free overdraft product up to $200. We've got a free secured product, and I think, we kind of get out there and really like emphasize that these products are, truly free and they're doing sort of good stuff, and we're able to kind of back that up with, sort of the data that shows the impact. Like it does resonate. And I think without sort of like getting out there and sort of emphasizing those messages, like I think people kind of tend to assume the worst. I think with newer products, like kind of in the EWA space, and we've even heard it kind of in just the short-term liquidity area, there is so much skepticism. So I think part of it too is like really being able to convey like what, we see from the consumer side, like what is it that we're hearing from our members? Like what is the need out there? And sometimes, actually, I think often we're closer to that than, the person that you might be talking to on, the regulator or the legislator. And so really being able to kind of share like the need that we're seeing, and sort of how these products are actually designed exactly to sort of meet that need, that you're not sort of just kind of putting something together and slapping a bunch of fees on it as like, as like the model. It's really about like what we're seeing and how are we trying to push to kind of address things that, aren't being captured in the way that traditional banking sort of works. So I think it's kind of like all those things that we've really seen as critical.
Well, I think we have less than 5 minutes. I want to open it up if there are any audience questions. If not, I have one more before we do kind of closing. I don't know how to, if there's a mic that we can pass. Should have thought about that before I opened it up. Okay, great, yeah.
From a fintech standpoint, do you think that there's a sweet spot to the number of bank partnerships that fintechs should pursue? Like, how many is too many? And maybe vice versa from the bank's perspective. Do you think that there's a limit to the amount of fintechs that you should partner with?
I think when it comes to a company like Affirm, we need to make sure that we're partnered with enough banks to cover our growth and origination volume. So I think that's constantly moving. It depends. If we partner with a large bank, then they can handle much more capacity than a smaller bank that we're partnered with, for instance. So we have, on the originating side, we have 3 different partnerships. Each bank is very differently sized and leveraged, and I think we're constantly watching that mix to see if we need to open up another partnership. And we're always on the lookout as to who the next partnership could be if we need it. But it does become burdensome when you're trying to meet the desires of 3 separate originating banks plus an issuing bank, which we have for our card product. It's a debit card, I should qualify. There's a lot of questions about what kind of product that is. But making sure that we're diversified enough to handle the volume, but also handle any unexpected regulatory scrutiny that could really slow business down for a particular bank. So if our largest bank partner has a heavy consent order that causes them to put the brakes on for some period of time, for instance, we need to be able to shift our originations to another partner. So it's a moving, breathing organism of our sort of bank partnership arrangements. I don't know if maybe one of you want to weigh in or chime?
Yeah, I mean, I think kind of like ditto to a lot of that. Like, I think for us, two feels like the right number, but it is something to sort of watch. But there is a fair bit of kind of like work that you have to do with your bank partners. So you want to make sure that you're being efficient and kind of like finding the right balance for your business.
Yeah, it's almost like if you go out and get a license in all 50 states, you have to manage to all 50 states' licensing regimes. But Chris would love to hear kind of her second part of her question.
I mean, my position's one, but I mean, and you guys are all, I mean, very humbling to be up here with all 3 of them. And you guys are well-established fintechs that have the ability to make that demand, right? And most fintechs, when they start out, don't have that ability. I mean, realistically for us, we, as much as possible, demand exclusivity because we want our small fintechs that we work with to know that we have proper oversight, safe and sound. We want to watch as much as possible to make sure that they're doing it right. You have teams of people who do it right? And so I think that balance from small to big is important. But I think certainly when you get to scale, then having diversification is an important business risk element that realistically I think regulation needs to take into consideration too as we think about how this needs to be designed down the road.
Great. Well, I think we've officially run out of time. I appreciate the question. And I do want to thank our panelists, Chris, Ellie, Ryan, and Mona for joining us today. And thanks to the audience for listening.